It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. With me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Are you feeling behind on your retirement savings? If so, there's good news. The IRS just recently updated limits to the 401ks and IRAs for 2023. So we're going to share those new limits as well as other ways that you can catch up on your retirement savings. All that and more on this episode of the Wise Money Show.
That's right. We're helping you with that and more. If you have a question or need some help or you are feeling behind, and this is the time to get that plan. Actually, not wonder, but know where you stand and that you're doing the right things. We'd love to help. You can call or text us, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com, and all over social media, wherever you're at. We are there as well. Search the Wise Money Show. You can connect with us, engage with us that way as well. All right, so we were chatting about the angle and sort of the direction of the show today, and right away Kevin said, yeah, how are you feeling? How are you feeling? That's the right question. So how are you feeling as it relates to saving up for retirement? And I know the market is volatile, and as Kevin also says, that's a feature, not a bug of investing. And so be a long-term investor. Make sure you've got the right strategies. But all of that, make sure you have it tailored and custom fit for your plan. So for that plan, for the reason that you're saving, for most people it's retirement. That's your big goal. How you feeling? Are you on track? Do you feel maybe ahead of pace? Or are you feeling behind? And we think most people probably feel behind. Statistics suggest that as well. And certainly the market coming down 27%, the bond market especially doing what it's doing, you might feel behind.
Well, it's probably the number one question that clients come into these days into see their financial planners. It's how am I doing, right? Yeah. And I think they already know how their investment portfolios are doing. I mean, you can see that on your monthly statements and everything. But what does it mean for your long-term outlook?
Right.
That's really what people are wondering. And the good news is just because the market is down, it doesn't mean that retirement's out of reach necessarily. Mm-hmm. There are things that you could be doing to make adjustments along the way. And obviously, we're kind of starting the show talking about saving more, but there's more things at your disposal. And if you're wondering that same question, you're not alone. We're getting that question a lot these days.
And not to keep on this tangent here, but isn't it amazing how many people are coming in doing the comprehensive financial planning? And as we look, and yes, the investments are down, the performance is off this year and down this year, but they're still on track for retirement. They still are. And so we'll see how this goes and all of that. But how are you feeling? Do you have that confidence that you're doing the right things, that you are on track? Or do you have that clarity that, nope, I'm actually off track, and here's what I need to do to get back on track? So the big idea, we're going to help you if you are feeling behind on retirement. We're going to give you some ways, 5 tips, maybe hopefully more, on ways that you can catch up. But none of this is a substitute to figuring out and knowing the actual answer, doing comprehensive financial planning, and then doing the 5-factor retirement plan to know, am I on track or not? I don't know the future, but I can have certainty that I'm doing the right things and I'm on track in the midst of all the uncertainty. So we're going to continue to weave that in. But guys, the very first way, if you're feeling behind, the very first way that you can catch up on your contribution is, maybe just capitalize on the gift that the IRS just gave you. And that is not a stimulus plan. Yeah, that was taken out of context. But in that they've expanded the contribution limits for 401ks, 403bs, even IRAs. Let's get into that. It's the biggest 401k increase ever.
Yeah, I was pretty shocked to see the numbers, quite frankly, because it seems like over the years they've been increasing maybe $500 here, maybe $1,000 there. But this year, it's pretty meaningful. And if you look, for example, at your 401k, if you have a 401k at work that you're allowed to participate in, the contributions went from $20,500 per year here in 2022 to next year it's $22,500. So, basically a 10% jump.
Yeah.
which is pretty significant. But then also another $1,000 added to the catch-up contribution if you're over age 50. So if you're over age 50, you can now stuff up to $30,000 into your 401k.
Yeah.
Unbelievable. I mean, these buckets are so enormous now, and you might say, well, boy, I wish I had $30,000 that I could be saving. And you know what? Whether you can save all $30,000 or if you can be making some steady incremental increases to your contributions, either one is a fabulous thing to be doing in a down market.
Yeah.
Take advantage of the buying opportunity here.
Yeah, the thing that strikes me and it makes me feel a little old, although, I mean, it's really just my body that makes me feel old. My brain still tells me I'm in junior high. But I think you go back to 1994 when I started in this business, and you could...
Can I guess?
Go ahead, yeah.
10 grand.
Oh, that's good. Josh is the best guesser in the world, which makes me not like him.
Back
Josh,
to what year?
1994.
6 grand.
94.
10 grand.
No, yeah. Mike, your first answer was so close.
Was it
Yeah.
10, 11?
It was 9240, which is a logical number. So it was 9240. So basically, and then in 96 and 97, it was 9500. So you could put 9500 in your 401k, and you could put 2000 in your IRA. Mm-hmm. And those limits, it is amazing how those limits have changed. So here we are, just 28 short years later, and they've more than doubled.
Yeah.
Mm-hmm. So the IRA limits have tripled, and the 401k limits have more than doubled.
So $22,500 is your 401k and 403b, whether you're working for a nonprofit. That's your contribution limit, and that's a big enough increase. Josh said, yeah, about 10% increase, and yeah, they try to keep this with inflation, although as you'll see with the IRA, not exactly, but that might be a big enough increase that if your plan is to max out your 401k or max out your 403b, and you're used to just doing that maybe by October, November, something like that, so I'll keep the same percentage. This might be a big enough increase that you actually need to increase the percentage that you're contributing to if your plan is to max the 401k.
If you didn't get a big salary increase,
right,
you definitely need to do that.
And like you said, Josh, the catch-up contribution moving from $6,500 to $7,500, so $30 grand total. If you're age 50 or older, that's a big deal. What about IRAs?
So IRAs are now up to $6,500 that you're allowed to contribute, plus still the extra $1,000 if you're over age 50.
So an increase, not meaningfully. Not meaningfully. I actually think the big improvement there with the IRAs is expanding the eligibility. So the IRA contribution limit, that is both IRA and Roth IRA. So it's not that you can do both, but they share the same contribution limit of $6,500, $7,500 if you're age 50 or older. But are you eligible to contribute to those? Josh, do you have that handy here? You hit that?
I want to say, is it 73 grand is where you start being phased out now if you're a single individual. And if you're a married couple, it can be as high as $218 before you start losing your ability to contribute. Now, there's some caveats in there. If you are a participant in a retirement plan at work, that number can come down just because of another quirk in the rules here.
Yeah, and one point of clarification, because a lot of times, people are confused about, well, can I contribute to a 401k or a traditional IRA? And I would encourage you, the answer is both. Mm-hmm. So think of it as you have two different coupons. One coupon for next year will be $22,500, and you can do that into your 401k at work. You can do that pre-tax, or you can do that after tax, and we call that Roth. And the same thing with a traditional IRA. And the reality is you can put $6,500 into a traditional IRA as long as you've got $6,500 of income.
Yep.
Or your spouse has it for you.
Or your spouse has
a spousal contribution.
Right, or your spouse has it for you. But anyone can do that. Mm-hmm. Bill Gates can do that. We always use him as the example of someone who makes a lot of money. Should we come up with someone
Elon
else?
Or somebody?
Yeah. I don't know. Anyways, we're certainly not going to use Mark Zuckerberg these days. So I'm wondering If you have something else to say, Mike.
Oh my goodness. Okay, so we're going to hit more of those contribution limits because what Kevin's sharing here is important about whether you can deduct your contribution or you if you're not eligible to. But I think the Roth IRA, there are some folks that look every single year and say, where's my adjusted gross income? Can I contribute to that Roth or not? And the eligibility limits or the income to make you eligible for a Roth contribution, that's expanded a lot. We're going to hit that as well. Simple IRA contributions, those expanded, we'll hit that. And then what are some other ways that you can catch up on your 401k or retirement savings? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning, also on podcast as well at the same time, also on a couple radio stations at the same time, which is why the content is structured the way that it is. All throughout the work week, though, we've got Next Wise Step videos that also air on this channel, taking one financial concept, applying it directly to your financial life. 10 minutes, 8-10 minutes, something like that. So more palatable content. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. Leave comments below, leave questions below. If you like the content, we appreciate it.
Good.
You cut off way too soon. I just want to make you had looked at it.
Well, I had a big ball of thoughts that could only
that weren't going to fit in
so glad I
15 seconds.
You're welcome. You're welcome.
No, they wouldn't have come out partially. It would have had to all come out at the same time. So I thought it'd be better just turn it back over to the host with the most.
All right. So one other thing that struck me, this is bonus content. Do you say coupon or coupon? So is it like it is a C, but it's the Q sound. It makes me think. Going back to Family Guy, or if you've got that pollution in your head, whip or whip. Is it whip?
No, it's whip.
No.
Okay, so what about coupon then? Tell me, is it coupon or
I've
coupon?
actually different eras of my life. I've been a Q or a coup. It's
what?
weird. I don't know. Maybe it has to do with where I was living.
That's crazy.
Because I think I was a Q.
Okay, so this show is about
the
financial
Detroit area.
planning,
No, this
so
is more
I'm
important.
calling tangent.
This is more important because I don't think I've ever heard you say coupon before. This really stands out. I got to question our friendship here.
Well,
You're one of those guys.
Coupon?
Isn't that what you had?
So you're a coupon guy?
Coupon.
It's got to be a Michigan
You
thing.
have a coupon, dude. You have a coupon.
Coupon. Yeah, I don't know.
It was coupon for me growing up, but I've converted to coupon.
Wow. Pretty soon you're going to tell me it's the BMV, not the DMV. That is so strange. So
It makes me grouchy either way.
Is
So
it the department?
Hey,
Or-
can we get the show over? Because
Okay, yes.
when we're done, I need to go to the ATM machine.
All right. With your coupon. All right, here we go.
Can you go to 10-10?
10-10.
Yeah.
10-10. Got it. Okay.
Mike, pay attention.
wow.
That's good. All right,
I think the show just ended right there. Can we be done?
Let's wrap this up and then get on to the next one. All right. All right. If you're feeling behind, and a lot of us are feeling behind with where you want to be saving up for retirement, how can you catch up? We're helping with 5 or more ways you can catch up on your retirement savings. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast wherever you listen. Search the Wise Money Show. Subscribe to it there. Follow us there, and rate the program there. We appreciate that. That's helpful feedback for us. Thank you very much. Okay, so if you are feeling behind for your retirement savings, I know you're probably thinking, well, I'm feeling behind because the market's down, and because the market's down, I don't want to contribute. But guys, successful investors, long-term successful investors are consistent with their contributions and know that during these market dips, these temporary, even if they last a couple of years, this is when you want to make sure that you're saving, if not saving even more. It takes a little bit more courage. Takes a little bit more conviction, which is why we'd tell you make sure you're working with your CFP, and all of this is based on a plan as opposed to just emotions. But now is the time when you can really make up a lot of ground by contributing even more right now while prices are low, possibly going lower. before they catapult higher and slingshot higher.
Yeah, and let's deal with a couple of objections just right up front. So one objection that I often hear from folks is, listen, I just want to either slow down or stop my contributions until the market comes back.
Right.
And yesterday we spent a glorious day with all of the financial advisors from Korhorn Financial Group together in one room. And we were sharing different ideas and how we're talking to clients about these things. And I think one of the best ideas that was shared with our team was a chart that Bill Mock had of a monthly contribution of $100 and what that $100 grew to, starting basically back in 2008 and going to now. And the $100 that you invested in 2000 at the bottom, let's say March 9th of 2009, has grown to over $400. It just $100 in the S&P 500 is worth over $400. Well, I can tell you this: on March 9th of 2009, no one wanted to invest.
Right.
So if you have a strategy that helps you keep the blinders on and keep going with your plan, that will help you. Quite often, that's where folks need the help from their financial planner, because their financial planner can encourage them, give them their courage, because this is a time that just emotionally, it just feels bad to you say, well, I just put $100 in and it's worth $92. Like, that hurts my feelings. Certainly it does. And that $100 might go to 70 before it goes to 170. Yeah. But that's what you have to be able to walk through and really look at some things that logically will help you and help you not be emotional.
Yeah, that's the key. And I think it has been normal, right? Like, many people are feeling like, boy, now is not a good time to be contributing because I'm just throwing money down the drain. We hear that often in a bear market. And I've even heard some folks say, I'm never going to be able to recover from this. I don't have enough time to recover from this. And you could tell yourself the story that you've seen the best there is in the stock market and is all in the rearview mirror. There's nothing good ahead. And I would just remind you, you look back on history, and the stock market's pattern has been a choppy, bouncy road from one new high to the next. And yeah, there are gaps in between. There are periods of time where we don't see any new highs. We're not reaching new levels and so on. But I was recently looking back at, just during my lifetime, hundreds and hundreds of times the stock market has reached a all new high.
Yeah.
It's 36,000 plus during the history of the stock market. 36,000 times the stock market has reached a new level. You would have a hard time persuading me that that's not going to happen again, right?
Yeah.
The stock market will recover, and it will often come faster than you think it will. And during that interim period, when you are staying steady with your contributions, or like we're saying today, maybe even playing some catch up on your contributions. If you're feeling behind on your retirement goal, getting more money into your plans during a dip like this is a fantastic opportunity for you. Yeah. And it may make the difference between you being able to achieve your goal and not. Because what if these contributions you're making today could quadruple in the next decade?
This might be one of your last great buying opportunities, depending on how close you are to retirement, what your age is, and all of that. And even if you say, well, I'm just getting started right now, well, can capture this. Listen to what Kevin just said. No one wanted to invest during 2008, 2009. We were convinced that the financial markets were ruined, right? And turns out that was almost a generational buying opportunity, if not a generational buying opportunity. So the IRS has expanded the contribution limits to 401ks by the biggest amount on margin. They've increased your IRA or Roth IRA contributions by $500. And that Roth IRA, going back to what we were talking about earlier, I used to think, well, married filing jointly, if your adjusted gross income is above $200,000, you really can't contribute to a Roth. You're making too much. They've raised that to $218,000 before that phase out starts kicking in. So that's a big deal. Simple IRA contributions, those have increased as well if you have a simple as opposed to a 401k, something like that. So those have increased from $14,000 to $15,500. The big idea is normally those contributions amount barely change from year to year, and typically like they'll change maybe one out of every 3 years. It's a big change this year. So work with your certified financial planner, see if you are behind, see what you should be doing if you need to catch up. And all of this connects with what's your tax shelter strategy. Should you be going pre-tax? Should you be going Roth? Should you try to max out your pre-tax 401k and max out your Roth IRA? Should you do spousal? Like that, this is foundational strategy stuff with your certified financial planner. All right, let's get to the next little hack here as a way to catch up on your retirement savings if you're feeling behind. And this one we often recommend right around the beginning of the year. Pretty convenient. We're just about there. And that is whatever you're contributing to retirement, increase it 1%.
Mm-hmm. That's a good one in good times or bad, right? It's just a great discipline or a habit to get yourself into. And it's really kind of your conscious decision on as you make more money over time, as you receive pay raises, as you get more hours at work and you're able to earn a bigger paycheck, is that increased income going to go towards lifestyle today, or is it going to go towards contributions and a better security for the future, right? Today versus tomorrow. This is one of the great disciplines that often separates those who are the most financially successful from those of us that maybe lag behind a little bit. And it's just delayed gratification, right?
Here's the thing, and this is where I would challenge you, because if I listen to this, I would be saying these guys are crazy. Because don't you increase my 401k contribution 1%? Don't you realize the price of everything has gone up? I want to reduce it 1% or more because life is so expensive. That's right. You had no choice. You had no choice. Chicken wings cost more today than they did a year ago, right? So does gas, right? Or depending on when things peak. But everything costs more today than a year ago because of inflation.
Right.
Don't you want then? Wouldn't you want to increase? I mean, you don't have any control over those other things. Wouldn't you want to increase then what you pay yourself by 1%? No one's going to force you. You're not required. Wouldn't you want to do that if everything else is getting more expensive? Wouldn't you want to? And then connected with that, don't you think that would be a wise thing to do? If prices are going up and will be higher in the future, wouldn't it make sense to increase your contribution by 1%? So I don't know if either of those help, but to me, it helped me get past the emotions of, no way, I can't do this, to, yeah, I need to actually. I need to.
Right, and if you need to, and you're saying, well, wait a minute, I can't. My wife just told me that hamburger was $6 a pound. She likes to stop at this place in Wakarusa and get 1 pound packs, and it's $6. And I'm like, how in the world? I mean, I think the world's going to start eating venison burger.
If you would, so if I was on The Price is Right and that came up and I had to guess the price, I'd say $3.30. That's where my brain is still at, right? But yes, that's doubled.
I would have said $1.
Yeah, well, yeah, that's right. So yeah, take that encouragement. Increase your contribution by 1%. Now, what are some other ways that you can catch up on your retirement savings? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. 10-10.
You hit that right on the money.
Dude, he's a killer.
Like a pro.
Okay, so here's the deal, though. It does feel like we need to acknowledge the struggle because, like never before, so it's possible that this year people might be getting either a low or a no bump at work.
Right.
Because the industry that they're in is struggling. Some industries are fine, but some industries are struggling. So I don't get an increase in my pay. You're telling me to increase what I'm contributing. And
everything's more expensive.
Everything that I'm listening to, even this this boom box that I bought to listen to the radio show on was more expensive.
Wow. You know what, though? Here's why I have confidence that people have it in them to pull this off. It's because the pandemic was not that long ago, and everyone realized what we can live without during the pandemic. Now, that might feel like ancient history, but I think there are ways that we can make choices in our own lives and offset that price increase to find room to make a better future. Not everyone's going to choose it, right? Mm-hmm. I hope our listeners do.
We have proof of that, though. What would you cite as Exhibit 1 for proof of that?
I don't know.
I would look at the data on credit card debt, because as soon as the pandemic hit, credit card debt outstanding dropped precipitously. And so I'm like, well, wait a minute. How in the world are people paying off their credit cards with with this difficulty? Now, right now, people are swiping those credit cards up and down, up and down, up and down.
Yeah, right.
Mm-hmm.
So it's going higher.
Mm-hmm.
But,
savings are dropping.
Right. But you are correct in the face of extreme worry, danger, fear, whatever it is, people can make some difficult choices for sure.
Adapt. Right. All right. Next one, HSA. What are some ways to catch up if you're feeling behind on your retirement savings? We're helping you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel, as well as a lot of other content. Chances are, if you've faced a financial question or quandary, we've got content about it. So go to YouTube, search the Wise Money Show, search that up, and once you find it, turn on notifications so you're aware every time we drop new content, this show, but also the Next Wise Step content that airs all throughout the work week. Find us there on YouTube. All right, we're talking about ways that you can catch up on your retirement savings if you're feeling behind. And while we're giving you a few ideas, the big question still stands. Do you know? Do you know, or do you just have a feeling? If you just have a feeling, sit down with your certified financial planner, build out that 5-factor retirement plan. Don't have them just point to, oh, well, look at this or look at that, and sort of do the shortcut, not in-depth retirement analysis, because it's not an analysis at all. The report that you get on your 401k statement, or when you log in, or an investment salesperson, a mutual fund salesperson, who asks you 1 or 2 questions and then tells you whether you're on track or not. I don't care if they've got a printout. If it's not a thorough 5-factor retirement plan that goes through Monte Carlo, talks through inflation, talks through Social Security strategy, all that sort of stuff, then it's not helpful. But you can do that math. You can work with your certified financial planner and get that confidence and clarity. A third way that you can catch up on your retirement savings if you're feeling behind is to change your approach with your health savings account. If you are eligible, change your approach with your health savings account from one that you actually use for out-of-pocket medical expenses, and instead don't touch it, but keep funding it and invest it for retirement.
You know, this is a tool that in HSA we've often talked about how it can be a tool for just managing healthcare transactions, right? You can set aside money that you've earned into this account before taxes. It can sit there and earn some interest or grow tax-free. And then when you pull it out to use it for medical expenses, it also comes out tax-free. So it's one of the only truly tax-free sources of assets that you have in your financial life. But if you're using it just putting money in and taking it right back out each time you run to the pharmacy or go to the doctor or anything like that, then we would think of that as more of an immediate spending type of a tool or transactional type of HSA. You need to recognize, though, that it doesn't have to be that way.
Yeah.
You can actually accumulate money in an HSA. And in fact, you can not only earn some interest on it, you can actually invest the money as well. And so if you've got cash sitting around anywhere in your financial life, but this is kind of a creative spot to go look, if there's idle cash that's not really doing anything for you, it has no growth potential to it because it's just really sitting there, actually losing ground because of inflation, one thing you could do is actually turn that into long-term investments that can be growing for retirement.
Yep.
Yeah, it's meaningful, the increase, because we went from 7,300 to 7,750. So the numbers kind of lose themselves on the radio, but I would just know if I'm an individual, I can put $200 more in my HSA, and if I am 55 or older, I can do another $1,000 of catch-up on that.
That's the 2023 contribution limits.
Yeah.
Yeah. Yep.
Yeah, so not just the 401k and IRA contribution limits, but the HSA contribution limits have gone up as well. Yep. So if you're going to do, so to me, I would look at it in one of two categories. Either I have a spending HSA, and that makes sense depending on your budget, depending on your family situation. You might say, I'm going to put that money in, I'm going to pull it right back out. I have a high deductible health plan, and we meet our deductible every year. And certainly the family with kids typically is going to hit that because there's a broken arm, a fill in the blank every year. But if you don't need to do that and you can live without those dollars, I think of the couple that's really preparing for retirement and trying to put it into another gear. If they're both 55 or older, they can put the 7,750 plus 1,000 plus 1,000 into the HSA. So you can put 9,750 into an HSA, and if you're putting that into an investing HSA, you can dollar cost average that money in over 12 months, get that money growing for you for the long term, just save your medical receipts as you incur them, and use them against those dollars in the future.
Well, and just like we were talking in an earlier segment, the contributions that you make during a bear market like this, if you invest that money, it has a better growth trajectory for it. And it may not feel like it because you may be putting that money in and then watching the dollars shrink temporarily as the stock market continues to fluctuate. But if we look out 5, 10 years, the growth potential on that money, it just has a steeper trajectory. As Kevin was referencing in the last segment, we were looking back recently on past bear markets in 2008. The contributions that people made at that time, many of them have quadrupled in value.
Yep. So I'm thinking of some folks that retired 2 years ago, and we're looking at sort of staging out their investment withdrawals, and of course talking about the markets and how things have gone. And it was very interesting because we had 2 years worth of cash, and they were going to buy a car, and they were going to do some other things. So that was going to, fill in that gap. And then I mentioned also, you still remember when we converted and shifted your HSA from you spending it each year to just leaving it there. And at the time, the way she had it structured, she had never invested it. It was just earning some interest. I think it was at a bank, an HSA bank or something like that. And so I think she even put it into a CD. In fact, she did. And so, okay, wait a second. Now might be the time. You're in your early 70s at this time, 2 years from now. Now might be the time that we pull those dollars, use them tax-free because she's got all the out-of-pocket expenses, blah, blah, blah. And that actually lengthens how much, quote-unquote, cash that you have available at your disposal from 2 years to 4 years. And based on your overall financial plan, blah, 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 that makes sense. And it was just, it felt like a boost.
Yeah.
It felt like a boost to their retirement savings.
So you're essentially saying rather than invest those dollars, you could think of them as available cash to give you more runway and let your investments rebound before you need to be tapping into them.
That's how it worked out in this individual situation. And I guess I would just underscore that the idea to say, yep, I'm actually not going to touch my HSA. I'm going to leave it there for my financial future to help with my retirement. Obviously, you could invest those dollars, but you don't have to. You could just continue to let them accumulate and just keep them low risk if you wanted to, right? But that still positions those dollars from near term to retirement savings, and that helps you catch up or get a boost in your retirement.
That's awesome.
So,
love that.
All right, fourth way to catch up if you're behind, and forgive the pun here, but it's simply to maximize your catch-up contributions. Now, those limits increase. We already talked about those. We'll hit those again. But people tend to make some mistakes, have some faulty assumptions around when they're eligible to start their catch-up contributions. Many people think, well, it's not until my exact 50th birthday. that's not necessarily true. And then sometimes people just forget, oh, yeah, I'm aware of that. And then you sit down and talk to them, they're 52, and say, oh, did you know you can contribute more? And they didn't realize that. They didn't realize they missed it.
Right. So those who are eligible, you're old enough to contribute more. You have the financial means to do it, but just administratively, you kind of missed it.
Yeah.
And it's possible that your payroll department at work may not automatically keep contributing for you if you've maxed out your 401k. Let's say you hit the limits, which this year are $22,500. I'm sorry, that's next year, 2023. You're allowed to contribute up to $22,500 unless it's a year that you turn age 50 or more. Then you're allowed to contribute another $7,500. Well, there are some people who, just because of a good income year or they've got aggressive contributions, they'll max out the 401k sometime in early fall. And then they go 2, 3, 4 months without any contributions happening. Well, that's a time where you could be taking advantage of this catch-up contribution, as long as your payroll department doesn't shut you off at the $22,500 mark.
Another example of this is, say you've been funding your Roth IRA or maybe your IRA and doing that monthly as an automatic withdrawal right from your bank account. That's how I have mine set up. And then all of a sudden, when you turn age 50, you never updated that number. And we see this a lot when these increases, these Roth contribution limits increase $500 or there. You never update that number. All of a sudden, you realize, I'm contributing a couple thousand less than I actually could, missing out on some of that opportunity. So there's a couple other warnings there to make sure you maximize that, as well as what are some other ways that you can catch up on your retirement savings if you're feeling behind. That and more coming up on the Wise Money Show with Korhorn Financial Group.
Did you see that they raised the income limits to be able to qualify for the Savers credit too?
Yeah, I did. Yeah, I was going to hit that.
It's crazy to look back. I mean, it was not that long ago. It feels like that you had to be under 50 grand of income.
That's the number I would have said.
But now it's what, 73, something like that?
Yeah.
73 for a married couple.
Yep.
That's amazing.
That's a lot of money.
All right, so we've still got a little bit to talk about with catch-up contributions. Then we can talk about bonus, gift, tax refund, how to allocate that into 401k, and then any other ways, and we can hit. I'm not sure if you have any other that.
Well, it seems like
list out.
We should hit the Indiana 529 increase too, as long as we're talking about increases and stuff that's deductible.
Doesn't really fit in with.
I think we've got to turn back to financial planning as well.
Yeah. We're going to do, Kevin, a show about contribution limits and all that sort of stuff coming up for kind of tax planning stuff. So I probably would not.
You want to stay focused on retirement?
Yeah. I don't think I would tuck that one in here.
Dude, my 529 plan is the key to my retirement.
And for most people, or for many people, it's the opposite. My 401k is the key to my college savings goal.
That's funny, not funny.
So.
Yeah.
All right, fourth segment. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Okay, we shared the increased contribution limits for 2023. The 401k contribution limit going from $20,500 up to $22,500. Your catch-up contribution increasing $1,000 as well. IRA, Roth IRA, those contribution limits are only going up $500, but still an increase. And then kind of using that to say, well, if you're feeling behind on your retirement savings, you now can contribute more due to these increased limits. But then here are some other ways that you can catch up. And before we get into the next one, we were just talking about the catch-up contribution. Some employers, now this isn't all of them, and it's fewer these days, it's less prevalent, but some employers, when you're signing up and making your investment election, how much you're contributing to your 401k, there's a separate section where you actually fill out a contribution percentage for the catch-up contribution. Now, I would say my intelligence is average, I don't understand that at all. I am not smart enough to get why they would ever do that, and if they did set it up that way, why they would keep it that way. But this is, I guess, what I'm suggesting is, we've seen this, that if you're looking at your total income and you wanting to, okay, I'm now 50, I want to contribute more, and you just go into your 401k and you increase your 401k contribution limit to a percentage that should max it out and get you into that catch-up zone, but you've got one of these weird 401ks where your catch-up contributions are a separate election, then you will get stopped off at that normal contribution limit, and you will not have any catch-up contributions. I don't know. It's still, it's rare, but it still happens.
You know, it's one of the reasons why periodically it is important to actually break out that pay stub and analyze it, right? I mean, most people get their pay stubs emailed to them, or it's available on some portal in your HR area at work, and you just never see it. It's just a direct deposited into your bank account, and you don't know what all the numbers and details are. And whether it is making sure that there isn't an interruption to your contributions, or making sure that your withholdings for state and local and federal taxes are right, like, there's just good reason, especially this time of year, to start watching those a little bit more closely for exactly the reason that you just brought up, Mike.
And if you're willing to take action on that and look at your pay stub, most pay stubs right now are digital. So most people don't get an actual paper pay stub. They have to log into an app or a website and access their pay stub. But I would also log into my 401k. And if you have one, or your simple IRA, or whatever you have, and look and see, are my contributions for 2022 on track? And is there anything I need to do differently for 2023? You might give yourself an early Christmas present, and if you're not maxing out your 401k, do that 1% bump that Mike was talking about, and not wait till the new year to do it. But it's amazing to me how many people we log into their 401k and we're surprised about things. So if I'm doing a quick check, I'm looking at how much am I contributing? Am I doing it pre-tax or after tax? I'm confirming that I've got a rebalance schedule going. I'm looking at the allocation that I have, and anything else that might need to be attended to.
Yeah.
The beneficiaries.
So last thing I'd mention here on this catch-up contribution is, I was meeting with someone recently who part of their sort of overall financial goals is max out his 401k every single year, and then they'll find a way to live on the rest, and they give a lot of it away as well. So he turned 50 last month. So he's going from contributing $20,500 to $30,000
Next year,
at a time when inflation and all sorts of stuff. But I mean, so that's going to be a big increase and be a big boost to their retirement savings. But you're going to need to be, Kevin's favorite word, planful. You're going to need to be proactive with that. That's not something that you can just say, yeah, okay, I'll just round up. No, that's a big increase. And so making sure you're aware of that ahead of time, that doesn't catch you off guard, and you can still do that and maintain if that's your plan. Yeah, I want to max this thing out every year. Oh, wow, that's a meaningful increase. All right, let's restructure the budget and make sure that we can do that joyfully and with confidence. So, all right, so number 5, the fifth way that you can get caught up on your retirement savings if you're feeling behind is what I would call capturing those pennies from heaven. So these sort of unexpected financial gifts or windfalls, and sometimes I think windfalls is like, it's got to be 6 or 7 digits, maybe, like big, like that's a windfall. No, I'm talking about $1,000 here, a couple hundred here. Capturing those dollars and shifting them towards retirement. I'm talking, a tax refund you weren't expecting, or maybe the one you were expecting. Then normally it goes just into the pot and you spend it a little bit over time, or a little bit of bonus or a gift or something like that. Pivoting that and contributing to retirement.
Yeah, you're talking about money that by definition it wasn't counted on, it wasn't planned for, it really is extra in the family budget. And, we talk every year around tax time, especially when people get tax refunds that are bigger than expected. The question is, that money that was not accounted for in your overall plan, Is it going to just allow you to do something fun and new that you didn't think you'd be able to do? Or are you going to use it to advance some project or some goal, that some initiative that you've already set as a priority? And if it turns out that you are behind on your retirement goal, these surprise dollars could be exactly what you need to get caught back up.
Yep.
So putting it to use for the things that you said were most important in your life, of course you would expect a bunch of financial advisors to tell you to do that, right?
But it's your retirement. And if you're feeling behind, if you're feeling like, well, either this is a great time to invest, I'm feeling that, I want to be a buyer at these prices, or I got a late start, or whatever it is, yes, we're going to encourage you to do that, but do it for you. Do it for you.
Yeah, and if you are listening to this and you're feeling somewhat hopeless, like, I don't know how to do it, I've tried to do it, it's not working, I can't do it, get some help from a financial planner. Make sure they're certified. And again, when I say financial planner, don't hear someone who sells investments. Hear someone who works with you to integrate your financial life in the 6 areas of financial planning, and make sure they're certified.
I want to get right back to that, because that's the main point. But how then do you capture some of these pennies from heaven, some of this unexpected, unplanned income? How do you capture it for your retirement? You might be thinking, saying, well, okay, so if I get a gift from, the folks or something like that over the holidays, I can't put that in my 401k, can I? No, you can't. You could contribute it directly to a Roth IRA. You could put it into your HSA, okay? Or if you've got bonus, there are some times where you can make a separate election for how much of bonus income you want going into the 401k. You could throw 50% of that bonus into the 401k, increase that election. If you know a bonus is coming, sometimes you're aware of that, and you can go in and increase your 401k contribution for that bonus and then drop it back down to where it was. There are some, it's going to take a little bit of effort, because naturally those gifts, those dollars, they are just going to land in the bank account, and you'll just spend through, and it'll feel better. But if you're feeling behind on your 401k or retirement savings, those are some ways that you can capture those dollars for retirement.
That's exactly right. And I would also encourage you that if you are realizing, or maybe just suspecting, that you're behind on your retirement goal, take that out of the wondering or the worrying stage and get it into the knowing stage. And you do that by connecting with your certified financial planner, reevaluating, take a new measurement on your readiness for retirement. Are you ahead of pace, or are you behind pace? And if you are behind pace, don't get discouraged. There are ways to get caught up, and that's what your certified financial planner's job is. As the co-pilot with you, helping to guide the plane to a great landing someday, they're going to help you understand maybe the adjustments that need to happen are to one more year of work, or maybe some more aggressive contributions. Maybe you need to adjust the investment mix itself. Maybe there's some additional tax savings that you could be capturing with some creativity. The point is, you don't have to sit here and wonder or worry. You don't have to resign yourself to not enjoying the retirement that you've been envisioning. Work with your certified financial planner to get back on track.
Absolutely. Absolutely. All right. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.